Hi, I'm Miloš Paps from the Edison Group, and I would like to welcome Paul Daggett, who is Managing Director at Neuberger Berman, the investment manager of NB Private Equity Partners. Thank you for joining us today.
Thanks very much for having me. It's good to be here.
Maybe you can start by providing us with an overview of the investment strategy of NB Private Equity Partners for those investors who are less familiar with the company.
Yeah, absolutely. The mission of NBPE is to invest in private companies to generate long-term growth. We seek to execute this by making direct investments into companies alongside top-tier private equity firms in their core areas of expertise. We build our portfolio investment by investment rather than through funds, and this allows us to actively allocate capital to sectors and strategies which we believe are most attractive at any given point in time. It also means we invest on a deal-by-deal basis without the need for significant long-term unfunded commitments. We look for high-quality assets and good industries with positive attributes such as industry leadership, limited cyclicality, high barriers to entry, pricing power, and/or revenue resiliency. In addition, we look for value-added private equity owners who understand the company, the business model, and the industry well, and which we think will be able to help position the companies well for long-term growth. These lead sponsors should have active, hands-on, execution-driven value creation plans for their companies. We invest globally, but are focused on the United States, which is the largest and deepest private equity market in the world, and we have fully integrated ESG analysis into our investment process. We believe NBPE has a strategy that is differentiated from other listed private equity vehicles, an approach which allows us to build a high-quality, diversified portfolio of direct investments in private companies.
Thank you. That's definitely a very useful summary. Now, private equity is considered an alternative asset class, which is, well, lesser known to some investors. Why do you think should investors look beyond public equities and expand their portfolios to include private equity investments?
Yeah, well, despite being a large and growing asset class, private equity remains a peripheral holding for many investors, as you say. However, we believe there are several reasons that private equity should be considered in more investors' portfolios. Firstly, the universe of private companies has continued to grow, so investors ignoring private markets are missing access to a significant investment universe. In a similar way, many small and mid-cap companies can really only be accessed through private markets, as many private companies are smaller than are typically traded on public exchanges. Finally, of course, performance. The global private equity industry has produced pooled average IRRs over the medium and long term in the mid-teens, outperforming global public equity indices over those periods. We think this outperformance is the result of a number of structural advantages that private equity may have over public equities, and these are, firstly, that private equity and specifically buyout managers are usually control investors, which work closely with portfolio company management teams to execute value creation strategies, such as moving into new markets, driving operational efficiencies, or executing M&A opportunities. This control not only gives private equity managers the ability to drive growth, but also allows private equity-backed companies to react to change quickly, whether in the face of economic uncertainty, disruption, or a new competitive threat. Private equity managers have a long-term horizon, generally 3 to 5 years, and they don't have to be driven by quarterly reporting. Finally, since we're talking about NBPE, I'd be remiss not to mention that one means of accessing private equity is through listed private equity vehicles, which can give investors access to an illiquid asset class in the form of a liquid share.
Thank you. That's very helpful. And can you also discuss the key advantages of a direct co-investment strategy compared to other private equity strategies?
Yeah, well, most listed private equity vehicles are either single manager direct investment portfolios or extremely diversified fund of funds. The single manager direct vehicles are often managed by very high quality groups with significant expertise. They typically have fairly concentrated portfolios that are exposed to only one single lead manager, and of course, the strategy where that manager is focused. Fund of funds vehicles, on the other hand, are often extremely diversified by underlying portfolio company, lead manager, and strategy. And this makes it more challenging for investors to analyze the underlying portfolios or for the individual portfolio companies to meaningfully affect performance. and they also usually carry a double layer of fees. So we believe NBPE's strategy of investing through co-investments provides potential advantages compared with these other listed private equity vehicles. NBPE invests directly into individual private equity-backed companies on a transaction-by-transaction basis, and this allows NBPE to have a portfolio which we believe is appropriately diversified, but not over-diversified. NBPE is currently invested in 94 companies alongside 56 lead private equity managers. The typical size of a new investment is 1 to 2% of NBPE's NAV. This limits the risk that an individual company can create for the portfolio if the investment does not perform well, but can still result in material gains for NBPE if it does perform well. By investing on a transaction-by-transaction basis, we can dynamically respond to market conditions and control individual investment decisions while investing alongside a wide range of top-tier private equity managers. Importantly, especially in a market like today's, we believe this approach allows us to be more capital efficient and remain fully invested without taking on significant overcommitment risk that can be created by committing to private funds. And finally, this approach is also fee efficient. Not only does NBPE typically avoid the double layer of fees generally seen in a fund of funds, but the management and performance fee rates we charge are meaningfully lower than those of the typical listed direct private equity fund.
Thank you. And can you also shed some light on the two core themes you focus on, that is long-term secular growth and low expected cyclicality?
Yeah, absolutely. NBPE's portfolio is focused on two core themes, as you say, which are, first of all, companies that we believe can benefit from long-term secular growth trends. These are trends or themes that we expect to continue over the long term and which may drive market growth and the companies that operate in them over that long-term period. Secondly, we also look for businesses with low expected cyclicality, either due to the market in which they operate or the specific model that they employ. Examples could be an insurance brokerage, which tends to be a less cyclical industry, or some of our software businesses, which have high levels of recurring revenues and high switching costs. Our portfolio companies addressing these two themes are in a range of industries, including technology, consumer and e-commerce, industrials, and healthcare. And in addition to these two key themes, we also look for companies that are owned and controlled by private equity funds in their core areas of expertise. We look for value-added owners who understand the company, the business model, and industry well, and which we think will be able to help position the companies well for long-term growth.
And finally, your shares currently offer an attractive dividend yield of around 5% based on the latest payments. Do you plan to sustain this dividend policy going forward?
Yeah, well, NBPE's dividend policy is set by the board, and the policy is to target a 3% or greater yield on NAV annually to shareholders, which is paid semi-annually. Our stated goal is to maintain or progressively increase the level of dividends over time. The board maintained the August dividend despite a decline in NAV in 2022 year to date, and so the most recent dividend was 47 cents per share, bringing total dividends to 94 cents per share, which is a 30% increase compared to 2021. At the current share price of £16.40, the annualized yield is 5%, and based on the 30th of September NAV per share of $27.24, the annualized dividend yield on NAV is 3.5%. When thinking about dividends, it's important to consider the capital position of a fund. NBPE has significant available liquidity, with the large majority of its credit facility currently undrawn. We also think NBPE is in a good capital position because of the way we invest, directly with a low level of unfunded commitments and not through fund investments. It's also worth noting that the 2022 dividend has been 2.7 times covered by the 2022 announced realizations year to date.
Well, Daggett, Managing Director at Neuberger Berman, thank you very much for your time.
Thanks for having me. It's been a pleasure talking to you.